Hello everybody, welcome to Monday Market Must-Knows. My name is Merlin Rothfeld, and here are 3 things to pay attention to for the upcoming trading week. Now first off, we've talked about bonds and yields on this program before, but if you've been in Bill Addis' Signature Series, he dove a lot deeper into it, and there's some very interesting things going on in that bond market. Specifically, we're talking about bond yields. That's the price that these bonds are paying investors. Now we'll start off by looking at 2019. What you see here is the yield curve, which is a representation of a variety of different maturities of treasuries and bonds. On the left-hand side is the short term. You can see at the bottom it says 1 month there. On the right-hand side is the long term. You can see at the bottom it says 30-year and all the various maturities in between. Now historically, the short end, meaning the left-hand side of this chart, should pay less interest than the right-hand side. That's a normal yield curve, where it slopes upwards. And the reason for this is, in theory, you should be rewarded for holding your money in these bonds for a longer period of time. So 30 years is going to pay you slightly more than that short term. That's normal, and that's 2019 in February. Fast forward 1 year to February of 2020. Now all of a sudden that yield curve looks strikingly different. What's odd about this is that dip in the middle. It's telling you that you would have been paid less interest had you invested in a 3-year bond versus a 1 month. So where's the incentive in buying the 3, 2, 5, 7, and 10 years? It wasn't there. That's an anomaly, but overall, it was still slightly sloping up, almost flat, but still going up. Fast forward to the dramatic part of this, which is current as of Friday. Dun, 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 dun. Look at that curve. Now, this isn't an anomaly. This is bizarre the way it's spiked up like this, and there's a logic and a reason behind it, and I'll explain. First off, that trajectory, which is incredibly steep, is dangerous for our markets. You don't like to see a separation between the long-term and short-term at that angle. Now, why is this so important for you and me? It's important for us because that is the cost of credit for businesses. They're using these bond markets to raise capital for their companies and also to sell bonds. Now, this may squeeze their profits, meaning that they're not going to make as much money, which, of course, could hurt the equity markets. It also means something for you and me. As consumers, what's the major thing that you're probably going to buy? One of the most important investments that most Americans make? Buying a home. And that's usually based off the 10-year Treasury note. You've seen that thing spike significantly. About 6 months ago, it was at 50 basis points. Now it's at 1.6. That's a huge increase in the value or the interest rate, meaning your 30-year fixed-rate mortgage is going to go where? Most likely to the upside. Now that may continue as well. Why? Well, think about what's been happening. COVID, obviously, we need to do stimulus packages and raise a bunch of money to pay all this. Now we have all this debt we've incurred. We need to now pay the interest on that. How do we do that? The Treasury sells bonds to sell that, gain the money, and then pay the interest. Now this is, again, important because there's been so much debt, they have to issue a record amount, a historic amount of bonds. They've never before seen this many 10-year bonds put to market, or 30-year, and now even a new one, the 20-year. When we have an incredible influx of supply, Online Trading Academy graduates here, what happens? You have a ton of supply coming to the market and very little demand. Where's price going to go? It's going down in a big way. That means the price of bonds are dropping sharply. In order to compensate for that and entice people to buy all this flood of supply, what do? They have to raise the yields. And those yields have been not just going up, but going up at a stellar rate. My assumption is that's probably going to continue because I don't see debt dropping by $3, $4, $5 trillion anytime soon. If anything, it's going to keep on going up. So that could hurt our markets going forward. That will take a long time to play out, but this will be the talk track for the next coming weeks. All right, number 2 on this list is going to be OPEC and the JMMC, talking about crude oil. That's right. Last week we talked about the price of crude oil inventories and how that was expected to decrease due to what happened down in Texas. Now, on Thursday, all day, OPEC and JMMC is going to be meeting talking about production increases to help the world with the price increase of oil. Now we've seen oil really start to move up. There's been some incredible moves in the futures market on CL. But bottom line is I don't know which way it's going to go. OPEC could say we're going to do cuts. They could say we're going to increase supply. If I'm OPEC, personally, I'll keep it right where it's at because a higher oil price makes me and all of my constituents much more money. But hey, let's be diplomatic. Maybe raising supply a little bit helps everybody out and we look like a much better person for that. Well, we'll have to wait and see on Thursday what happens, what it will do. And I can guarantee this. It's going to create a lot of volatility in oil on Thursday, so be careful. All right, finally, move on to the earnings calendar, which is a fairly busy week for retailers and not much else. 578 companies reporting. That's about half of what we saw last week. On Monday, you've got NIO, the darling car company that's out there competing with Tesla, Novavax. Tuesday is the onslaught of retailers. Target, Abercrombie & Fitch, Kohl's, Nordstrom's, Ross Stores, Urban Outfitters, and AutoZone. Everything in green is a retail public-facing company. On Wednesday, you've got Splunk, Marvell Technologies, Dollar Tree, and American Eagle Outfitters. Thursday brings you Broadcom, Sienna, Kroger, and Burlington Coat Factory. Yes, we're all rushing to get coats with the winter chill. And finally on Friday, there are more than just this one, but Big Lots is the retailer reporting on Friday. That will be most of your big names for earnings season. Of course, there are more than that, so make sure you check your earnings calendar. But that, my friends, is your Monday Market Must-Knows. We'll see you next time.